smaller funds wouldn't be able to access without our capabilities. I've been in financial markets for most part of 20 years. 15 years of that's been in prime brokering, securities financing, clearing services based in London, Asia, and in Australia.
Awesome. Thanks, Warren. Willie, on to you.
Thanks so much. Hello, everyone. Thanks for joining. My name is Will, the founder of Focus Fund Solutions. Focus was established late last year with an aim to provide bespoke operations, data intelligence, and automation technology solutions in funds management industry. We are currently servicing fund managers, both boutique and institutional asset managers. Also work with admins, trustees, and advisors. Our solutions and services cover back, middle, and front office areas. Some of the typical benefits that we deliver to the clients are institutional-like processes that are sought after by institutional investors and asset consultants, data insights for improved investor relationship or engagement, enhanced portfolio insights and investment selection process for the portfolio managers and analysts, robust trade life cycle management and book of records maintenance, eliminating these manual touch points in-house. Thank you.
Thanks, Willie. And now Nathan and Tom, if you guys wouldn't mind making an intro.
Yeah, good morning, everybody. It kind of feels very special today, wearing a blazer and a collared shirt for change instead of the lockdown sloppy Joe and stuff. But so we're from Gilbert and Tobin. We've got a team of about over 50 people that work in the investment space, and we basically cover everything from the regulatory side to the fund formation, getting people out of trouble with ASIC, launching listed funds, credit funds, private equity, venture capital, infrastructure, real estate. I mean, we pretty much cover the whole spectrum. We've got a team of over 50 people now, and we've got some really interesting practices across fintech and other areas that touch this. So we spend a lot of time looking at how do we build fund products that match investor demand. We spend a lot of time connecting our clients with different investors for different transactions and funds, and just enjoy sort of coming up with new innovative ways to do this.
Awesome. Thank you, Nathan. So guys, I guess we'll kick start with a lead question, and I'll share it on the screen. So first question is, which service provider would you go to first when setting up a fund? So I don't know if you guys can see. Yep. So we're getting a few answers coming in. So maybe I'll just kickstart and comment to this. So when I was incubating funds in Singapore and Hong Kong, we were essentially helping out a lot of newly launched hedge funds set up across Asia. And the first thing that they would usually go to is the prime broker, essentially. They'd go to the prime broking consulting desks, ask them, hey guys, which service provider should we be choosing? Can you help us raise money? And how do we build a fund management business? So, from the answers that we're getting on the screen, it seems that most of our audience will go to the lawyers first. So maybe Nathan and Tom, you guys maybe can comment in terms of what are the sort of, questions and considerations a startup fund manager should make when approaching a lawyer and setting up?
Yeah, sure. Look, I'm very happy that everyone said lawyer first. I'm just disappointed there wasn't a Gilbert and Tobin button there to say as well. But look, I think I think lawyers do, in a very self-interested way, do make sense early on, because we do tend to know and see a lot of the service providers and who has worked and hasn't worked on different funds. So I think it's we sort of don't have a vested interest in who we promote, and sort of try and give it, I guess, an unbiased approach on that. The second thing is, a lot of fund managers when they're starting out, and we do help a lot of small ones as well as a lot of very large ones, it's really about keeping costs down and making sure that you're not spending money on things that you can avoid at this point in time. And so one of the things we do is sort of help stage people with their growth and their setup so that, you're incurring costs only when you need to, and you're sort of minimizing that upfront stuff. So I don't know, Tom, if you want to add anything to that, mate?
Yeah, so typically when we have new clients come to us or return clients, obviously we have a lot of investor-facing exposure as in addition to GPs facing exposure. So we can add a lot of value by helping you to structure your products in a way that LPs are comfortable with and have seen in the past before, and also help you to structure your fund in line with market terms as well, which is one of our big value adds given the breadth of the market we cover. So typically that'll start with the term sheet where we can work with the GP to determine what their terms are going to look like for their fund, whether that be a hedge fund, a credit fund, or private equity fund, VC fund. And then we move in to long form documents and investor negotiations if required. So yeah, that's generally what it looks like from a starting point and where we can add value in addition to what Nathan gave.
And what about yourself, Warren, from a prime broker's perspective? I guess what sort of questions do you get when a fund manager's launching?
Yeah, well, look, I would probably start by saying that I'm not surprised to hear that funds, from your initial polling, would go to a prime broker first. And traditionally, prime brokers have offered things like capital introduction and what have you, and that's been a way that budding fund managers would discern where to get their capital from and certainly launch their fund. But with the advent of MiFID and what have you, it makes a lot more sense, and it's good to see that there's a lot more sensible approach in going to where you actually have to start, which is the lawyers in Sydney, and from people in Australia, it seems to be a bit more of where to start. But look, from a prime brokerage perspective, when people come in, we really need, we sit at the heart really of what a fund manager does, and we service the broad spectrum, everything from execution down to the administration tasks, back office, dividend processing, corporate actions. And so really, the prime broker would probably do, has a touch point of probably 90% of a fund manager's business. So it's highly important that you choose the right prime broker when it comes to this. Now, the sorts of questions that we get, it's probably more so the questions that we need to understand, and that's really what the strategy of the business is going to be. And I would always sort of suggest that before going to a prime broker, that the fund does a lot of self-analysis and really tries to understand what their strategy is, what their process is, how concentrated they are, how will they be hedging. And these sorts of questions that prime brokers really need to understand to, one, ensure that the pricing that we give them is correct, and two, that they get the right service that they need from us. And so it's a bit of a two-way conversation, but really I would say having a real clear understanding of what it is you require, and even going beyond for some certain things that may not be the core of your business, which you may need, which we see a lot in Australia. We see funds that would be Australian focused equity managers that finally all of a sudden find out they need access into Canada because there's a dual listed resource stock or something along these lines. So really having good understanding of what we're trying to do.
Mm-hmm. And Eric, I guess I've just shared the poll results to the attendees as well. Obviously, we see the fund administrator there getting 18% when people are looking at setting up a fund. I mean, what sort of questions do you generally get from emerging managers when they approach the fund administrator for the first time?
Well, thank you, Omar. Well, first of all, I agree that quite often fund managers already have spoken to a lawyer and have a kind of idea in their mind how to set up the fund. And what we often do as fund administrator is we're trying to fine-tune the business model. We start discussions about, okay, how frequently would you like to report to your investors? Are you looking for a daily unit price calculation, or maybe weekly or monthly, or depending on your assets, maybe even biannual? We start discussions about fee structures. A fee structure in a fund basically depends on the type of investors you onboard in a fund. Fund managers are getting paid a management fee, they're getting paid a performance fee. There are all kinds of ways to calculate performance fees. And well, to name one, equalization is a very complex way of calculating performance fees. But we know already that does not work for the retail market, because quite often retail investors don't properly understand how such a calculation works. So if we know when we start talking to a fund manager that they're trying to reach out to wholesale investors or retail investors, we already start discussing those fee structures and give them the advice to follow a specific route when they build their product. Same when I trying to raise capital onshore or offshore. Australia is very much focused on Australian unit trusts, and it's very hard to sell a unit trust overseas. So if you focus on offshore investors, you probably shouldn't go for a unit trust. Those type of discussions we have in the early days when a fund manager knocks on the door and is basically talking to all the different service providers involved in setting up a fund and fine-tuning the product.
And I guess with you, Billy, I mean, what sort of initial questions do you get from startup fund managers, I guess, on the technology and the reporting side?
Yeah, absolutely. Yeah, right now, the fund manager is dealing with more and more data-oriented world. There's a lot of data sources coming from different providers, such as the custodian, the prime brokers, or even the administrators. How to manage all these things become quite a nightmare if you don't have the proper infrastructure in place. So I do get a lot of knock on the door, like what sort of solutions we can look at, and the main thing for me is providing a very tailored solution for the client, because there's no two clients or one client is the same. Basically, in the sense that the fund manager that manages the same strategy will still be very different in the investment style, as an example. So, yeah, so the typical questions that I would normally get is, how do we manage all these? The trade life cycle from the operations perspective, how do we manage it? Who are the service providers that we need to deal with? All these things, those are the key questions that I normally get. And I do have a range of contacts as well that I refer to my networks, basically.
Yeah, but I mean, I think that leads to my next question, guys. And I'll share that again with all the attendees is, what is your biggest worry when setting up a fund? Now, dealing with a lot of these emerging managers myself, I mean, I must say the biggest worry that they have is not being able to raise the money. A lot of them come from big houses, being portfolio managers at Goldman, Barclays, wherever, but they may have not had the experience in terms of raising money before. So I see that as being a challenge, as well as them not really having an understanding of what an expense ratio of a fund is. So perhaps, Eric, if you would like to kickstart that off, when you get fund managers approach us, Ascent from a fund admin perspective, what are their worries and what should they consider?
Well, what we keep telling fund managers is they really need to make sure they're building what we call a professional infrastructure. And a professional infrastructure means you need to be able to prove to your future investors that you got a proper segregation of tasks and responsibilities. We've seen in the past a number of cases where a single entity was trying to control the entire fund structure, which led to fraud transactions, and basically a lot of investors have lost their money. And a Madoff guy in the United States is a very good example a couple of years ago. So it's very important that you make sure you build the professional infrastructure, but that will cost a bit of money. I mean, Australian unit trust, you need to have an auditor, you've got your fund administrator, you've got your prime broker custodian, your trustee or RE, depending if you reach out to the retail market or the wholesale market, the prime brokerage custodian. So if you all add it up, you're probably spending already maybe $100,000 making sure you're putting all those service providers together. Well, $100,000, if you start thinking about an expense ratio, how much would you really want to charge back to the fund? If you say 1%, as an example, and that's excluding any management fee a fund manager is charging back to the fund, that means you should already have close to $10 million to kind of run it in an efficient way. And that's not always understood. And well, sometimes people, because they got less money to start a fund, trying to carve out specific service providers to save some money. But we keep saying that don't do it, because you can carve out certain service providers and maybe take some of the responsibility on board by yourself, but it will be harder to raise capital. Because for investors, it's very important that you can prove you got that segregation of of tasks and responsibilities in place. So it's trying the proper balance, and yeah, you will need to have a number of assets to run a fund in an efficient way.
Yeah, but I guess that I'll just share the results with the audience as well, so they can see. There we go. So the biggest worry, I guess, for most of them is raising money and cost of running / setting up a fund. So maybe Nathan and Tom, in terms of setting up a fund, given that's the second biggest worry for most startup fund managers, can you give ballpark figures? What does it cost to set up a fund nowadays? And what is your I know it varies quite a bit, but what would you comment to that?
Yeah, look, I think to Eric's point, the most important thing really is to get the scale right, and scale the expenses to that scale. So, if you're only going to raise 5 mil or 10 mil, then you've got to build a fund structure that makes sense for that. You don't over-engineer it. One of the things we see a lot of people make the mistake is they go and want to set up a Cayman fund or a Delaware fund, and they're just too expensive to do unless you're getting, in my view, you need a good sort of 40 or 50 million Australian at least to justify those kind of structures. They're expensive to put together. Typical Cayman fund, is sort of roughly 60 to 100,000 to set up. But then you've also got economic substance issues at the moment. You've also got to have 2 directors a year, which often costs 20 to 25,000 US a year. So there's a lot of expenses in doing that. What I prefer to do is, sort of set up something really simple. And, we often help startups try and get a fund up for sort of 20 grand or 30 grand Australian. It might not be the most ultimate structure for them, but it kind of makes sense given where they're at. And I think, Omar, as you and I talked recently, one of the issues a lot of people do is spend too much time negotiating prime broker agreements and wasting money on that and just not getting any value for that. So again, what we try and do is guide clients to, spend the money where it counts. And then I think lastly, the most, you said on that survey, the biggest worry of people is raising money. I think the biggest issue is a lot of people don't understand their market. They don't understand what investors are looking for, what they're investing in and what they aren't. And they also, so that's one of the things we try and help them with. And secondly, making sure that you differentiate yourself in the market. There's plenty of other fund managers out there, right? Why are you, just because you spun out of Goldman's or spun out of Perpetual or whatever, why are people going to back you? You've got to give them a good reason to take the risk. So I think that's, again, one of the things we try and do is work with people to get their messaging right.
Yep. And I guess, Willie, from your standpoint, I guess when you have fund managers approach you, do they generally consider, running their operations as a big worry, or what sort of challenges do they bring up to you when they're thinking about setting up a fund?
Yeah, at a certain stage, definitely that's their worry. So during a startup, normally that is not the typical issue that they'll bring up. So the focus will definitely be how to raise money, how to get revenue into the door, and how do we scale up. And after a certain stage, they'll start considering, okay, how do we streamline the operations? Can we bring in the best practice or standard operating model in-house sort of things? That's when it all comes in. But at the same time, it really depends on what sort of market we're playing in. Basically, if the fund manager is targeting retail money or wholesale money, there's obviously different messaging, as Nathan mentioned, that we need to put out to the market for the fund managers to be recognized. There are tons of fund managers out there. How do you differentiate yourself? As Nathan mentioned earlier, the key thing is always going to be the returns. There's no doubt about that. And the second thing is the team buyer of the fund managers. But as we know, nowadays the world has become more and more technology driven, more digital, basically. And nowadays, we're working from home, working remotely. We collaborate remotely within ourselves, within the team. How do we ensure that the investors are comfortable with all this, approach? How do we ensure that sensitive data is not leaked out? So there'll be millions of emails going in and out with Excel attachments, as an example. How do we streamline that? How do we make it better? How do we work more efficiently? I think you know, that goes hand in hand. Basically, you know, there's always a consideration that the fund manager need to put in terms of their technology infrastructure investment.
Yeah, no, totally agree. And I guess for yourself, Warren, I mean, let's say I'm a startup fund manager, I come and approach Lazarus Capital. Is the first question always, can you raise me money? Or what are the, you know, prospects generally asking you when they are setting up a fund, and what are their worries generally? Is it really the raising of the assets, or is it just getting a PB relationship going?
Yeah, oh, look, you know, without doubt, I mean, you know, how can you help us raise a capital is always a question that you're always going to, you know, we're always going to field. And as a service, it's not something we at Lazarus Capital Partners do. And I think I touched on it previously as well. You know, in the past, it's been how hedge funds have discerned how to choose a prime broker, you know, on their capital introductions, what have you. But there's really quite a lot of conflicts of interest that come into those sorts of relationships. And with the advent of MiFID, you know, we're seeing that sort of value-added service come off somewhat. And look, certainly we'll do introductions where we can, but it's certainly not a service that we charge for or advertise as a service that we do. But, you know, to touch on what actually Nathan was talking about earlier on, you know, negotiating prime broker agreements and what have you. And we do, you know, I have seen that in the past. And to be quite honest, I think it is, as a startup fund, and it feeds very well into what Nathan was saying, you know, negotiating prime broker agreements, quite often the details that are there, they're not really up for negotiation. And the sorts of things that we see wouldn't really have a large impact necessarily on the fund itself. It's got to do with timing and, you know, what to do in events of bankruptcy and what have you, which you know, are all important, but not necessarily game changing for the prime broker. And you've got to understand also that when, you know, if you're looking for a you know, a bespoke prime agreement, I suppose, which falls outside of what we would offer to standard clients, you know, you become a special case, and you've really got to have a good business case, and you really got to have a good business case for you know, for a prime broker to want to take that on board and have to think about your business differently. And whilst it's all well and good, you know, it's similar again, you know, ideally they'd love to have a Cayman's fund and have $100 million, but if they've got $10 million or $20 million and spending $100,000 on trying to negotiate prime broker agreements, it's probably not money well spent. And I'd say, I think the other thing too that I've seen a lot of change in recently certainly comes to onboarding as well. And, you know, we see managers coming, you know, ex-Goldman, you know, come out of, you know, spun out of some of the well-known hedge funds and or ex-asset managers looking to go out on their own, and, you know, they immediately assume, okay, well, we're going to start up with a prime broker with Goldman Sachs and Morgan Stanley, and you know, 15 years ago that was probably, you know, a fair enough way to go about it. But things have changed, and I still don't think there's a good understanding of hurdle rates and what they mean for funds and at different prime brokers, and it can, you know, sometimes the hurdle rates that you have to pay as a minimum fee is effectively to a prime broker could eat into 1%, 2%, sometimes even 3% of your you know, of your assets under management, which is, you know, this all comes down to performance. So, you know, and not only that, the onboarding time can sometimes be anywhere from, you know, 3 to 6 months, and we so often see funds that, you know, have tried Goldman's, tried Morgan Stanley and couldn't get through, and told at the very last moment that, you know, sorry, the new business committee in New York has just knocked you back. And they have nowhere to go, and they've spent 6 months, you know, that's eating into, you know, your capital, it's eating into, you know, all your operating costs, and you can't even get your fund running yet. So, you know, you should really look at all avenues, and certainly not discount, you know, the more boutique operations such as ourselves. It can certainly speed up the onboarding and trade and to get your business up running quicker.
Yeah, no, exactly. And I mean, we realize a lot of the boutique operations, I mean, their hand-holding approach is a lot better. And in terms of, you know, if you're not meeting certain minimum commission rates, the boutiques are not kicking you off the platform. I mean, we, in my past capability, we had used some of the tier 1 prime brokers. And if you weren't generating them 150,000 in commission, they would kick you off, and then you're left without a PB. So I think considering all service providers that are out there is very key, not ignoring anyone.
I think you're right, because we often see, a fund might be given, they might be supported and they'll get 2 years down the track and not necessarily meet the expectations or the minimum hurdle rates, and then get kicked off. And then it's like, a prime brokerage relationship it's more of a marriage. You can't just switch between executing brokers. You've got to move positions. It's a task once you're set up to then move it. So you've really got to think about the risk of that potentially happening down the track.
Agreed. And next question that I have, guys, again, this is also for the audience, and I think this is something I've seen quite a bit in Australia. So the question is, do you think that doing your own fund accounting internally is good practice? I've seen a few smaller funds in Australia do fund accounting themselves. Now they're generating their own performance numbers. As you can imagine, that has huge risks involved with it. I did not invest in this fund manager because they were doing their own fund accounting. It was a huge red flag for me, because you can put out whatever number you want if you're doing it yourself. So I guess question to Eric first, given this is your realm of expertise. Do you think this is good corporate governance if a fund manager is doing their own fund accounting?
Well, of course not. And not because I'm representing my own business now, but it all comes back to what we mentioned before and discussed before: segregation of tasks and responsibilities. I mean, you will need to show this to your investors. It cannot be the case that a fund manager is calculating his own fees. And let me explain this in a bit more detail. Fund managers, they often receive a management fee, and the management fee basically is for them to cover their operational expenses. And they also receive a performance fee or an incentive fee, and that's based on their performance. If they start valuing their own portfolio, if they start calculating their own fees, there is no proper segregation of tasks and duties anymore. I mean, an investor doesn't like it. They want to make sure that an external company, an independent third-party company, is looking after all those fee calculations. So that's why it's very important. Secondly, you're not just doing fund accounting on a off-the-shelf bookkeeping system. Fund accounting systems are very sophisticated and complex systems supporting all kinds of different fee calculations, all kinds of different fund structures. Think about multi-class, multi-currency, underlying SPV structures. You can't do this by your own in a simple bookkeeping system. So that's why it's very important that if you really want to run your product in a professional environment, that you connect to those that have the experience, to those that have the systems. And for you as an investment manager, an important tool to provide and to show your future investors, yes, we do have independent service providers supporting us running the fund.
Yep, and I guess from a, let's say, legal standpoint, Nathan and Tom, is this something that you guys give guidance on to your, startup fund managers? Do you tell them, look, guys, for corporate governance sake, it's good to have a third-party administrator, or do some of them still not worry about that?
So I think, so I've got a slightly different view to Eric. I think it depends on the fund. So a lot of venture capital and private equity funds, for example, do self-administer. And I think given the scale of a lot of these funds, we'd only have a couple of, maybe up to 10 investments, and there's no valuation. So the fees don't run on the back of valuations. It's all cash-based. I think in those situations, you're seeing the top institutional investors around the world get comfortable with that approach. And the reason is because we have checks and balances like, investor advisory committees and auditors and things like that. So I think in that situation, it makes sense. But I agree with Eric, in terms of, other situations, administrators just have that degree of expertise and rigor in their systems that I don't think any fund manager can generally compete with. And and so I think that's really important. There are some credit fund managers out there that self administer, but they usually again have a check and balance where they might get EY or something like that to check those on a quarterly basis to give investors comfort. So I think it just depends, I think, on the fund, but generally, I think there's a bit of a conflict of interest in that. I don't know, Tom, if you've got anything else you want to add.
Yeah, I think you're exactly right. It's contingent on the type of fund. We more commonly see an administrator appointed in respect to credit funds and hedge funds, where obviously the accounting processes are a lot more complex, where they're required to do series accounting in some circumstances and strike NAVs quarterly, semi-annually, or weekly in some circumstances for the purpose of striking performance fees. So that's where it can be particularly important. But as Nathan says, in respect to VC and PE, in more cases than most, GPs will self-administer in terms of accounting, because typically they only have to strike their carry, only a small number of times.
So I guess I've got the results up on the screen, and most people agree. I guess no one should always appoint a third-party administrator. A couple of guys, maybe you're right, these are VC guys that saying, look, it's saves me fees from appointing an administrator, and 4 people are still indifferent about it. Willie, any comment to those sort of results that you're seeing from a fund admin perspective?
No, I tend to agree. Like the most common practice would be assigning a third-party administrator, definitely, just purely from risk perspective. As well, if you strike a wrong unit price where you have to reimburse your investors or whatever it is, that can be a nightmare situation for the fund to bear, or for the manager to bear, sorry. So typically it's encouraged to do so, but I also agree with the comment from Nathan and Tom that some funds with the different structure, they do not need any fund admin externally. But most likely it will fall under the bucket of fund admin outsourcing.
And I guess leading on from that, I mean, obviously service providers are so important when you're launching a fund, and I guess this is directed to Warren. When considering a prime broker, what is important to you as a startup fund manager? So there's sort of multiple choice. We've got his ability to give me market access, no pressure on hitting minimum fee hurdles, capital raising ability, again, seems to be getting a bit of response, pricing, leverage, and some people are not sure. They want you to enlighten them. So Warren, please enlighten us.
Look, I think, definitely understand, going back to the points I made earlier, is really understanding what it is, what strategies is you're going to be trading, and what your requirements are in terms of market access, and what they may be in the future as well, because quite often, startup funds, they'll be very Australian equity focused, and then before you know it, they've got exposures in in Canada and some of the or in the US through some sort of tech deal that they may be involved in, and then all of a sudden they find that they need to be up trading at night, or they they need to have the ability to have quick access, still cross collateralize their positions, and perhaps even incorporate some derivatives into that. So as the fund grows and as their strategy grows, they need to be dealing with someone that has the ability to deal with all those sorts of things. I think that's probably the most important thing, but it would be market access. But second, well, not second, but what I would say is probably the most important is really getting an understanding of what the risks are that you have with dealing with your prime broker, and potential counterparty risks. We've seen problems in the past with the collapse of Lehman's and some of the more Australian focused problems out here with the likes of Opus Prime and what have you. You really need to understand the risk, how your prime broker is managing the risk and how that's going to affect you. Are they going to be changing margins on you quickly? Are they are they overextending themselves to some degree? And you should be able to understand that by looking at what the prime broker, is able to offer you as margining and as risk, as a risk format, and you should be able to extrapolate that and go, yeah, look, I'm comfortable with what they're doing and how they're managing their own balance sheet, because the last thing you want to be in is in a situation. And although I think things have changed dramatically since in the past sort of 10 years or so, you should always get a healthy appreciation for counterparty risk.
Yeah, can I just maybe add on that, Omar? I think Warren's point's one of the most important. A lot of fund managers starting out, including some established ones, don't know that you can get insolvency remote structures with prime brokers these days. So coming out of the GFC, a lot of the big ones are now offering that, but obviously they're not going to offer it up unless you really want it and ask for it. So it's really important to look out for that. And secondly, as Warren was saying, there's a lot of terms in these contracts where they can basically turn the tap on and off and sweep your account and have it all on balance sheet, on their balance sheet. You end up becoming a cents in the dollar creditor, which is obviously means your investor funds are completely at risk. So just a couple of things to look out for, I think.
Yep. And I guess the sort of big question I think a lot of attendees are here for today, guys, is what makes a successful fund manager? Now, maybe I'll share an example that I had maybe on the other end. I was capital raising for my first job once I moved to Singapore, was raising money for a volatility arbitrage hedge fund. And I was doing that for a year. Raising money was the toughest thing. We started with 10 million. Most of it was the founder's money. Performance was okay. We had maybe 100 investor meetings in the first 3 months. And in the end, we only had a 100,000 ticket that came in. So it is a lot of hard work just to get a ticket as a startup fund manager, because I guess you need some form of track record. People need to know you. This fund manager didn't have a background. It was just a wealthy individual trying to run a fund. And in the end, the fund after 3 years closed because we couldn't raise money. So this is probably not a success story, but it tells you that, performance matters a lot. We were probably just benchmark hugging, so it didn't really work out well for us. Plus, we didn't have the brand in place that a lot of the fund managers, a lot of the investors wanted, but we had an institutional back office. We spent so much money on setting up our systems, risk management, we had prime real estate, but if performance isn't there, you may not succeed. So maybe, Eric, I guess you've seen multiple different funds ranging from VC, PE to hedge. What makes a successful fund manager?
Okay, well, I think as a starting point, you will need to make sure you got a decent start capital. If you start with a low asset base, it's very hard to build your business. Presuming you got a decent start asset base, well, first of all, try to perform consistent. And what I mean by this, investors quite often don't like volatility. And of course, it all depends on the underlying asset class. Some asset classes are very stable and perform slowly. Others are very volatile, but try to perform consistent. I think it's very important, and we're repeating a little bit the webinar now, to show that you got a professional infrastructure in place. You can show to your investors and future investors that you are in control of a segregation of duties and tasks. I would say spend the extra dollar and make sure you stand out from your competitors. Think about different ways of reporting to your investors. Pamper your investors. If you've got overseas investors, start talking to your fund administrator and create reporting in their own language. That you stand out from your competitors, not just offer a standard reporting to your investors. I think if you keep it all in mind, and you do have a good product, that's of course very important. Yes, you're on the radar, and investors will look at you, and over time you will be able to raise the capital.
Yeah, no, totally agree. And I guess perhaps Warren, for you, I guess you guys service a lot of emerging managers, and I guess you must see them at the very early stage to a point where you see some of them succeed? I mean, is there, I guess, first question, I mean, what do you see? Is there a certain trend in success that some of these fund managers display?
I think we touched on it as well. I think what a lot of fund managers, in their initial stages, what they fail to really appreciate is some of the hidden costs that are associated with, poor service or poor execution when it comes to the management of their assets. Certainly, being able to run, a very cost-effective operation is key. Is key to sort of getting through the first 12 to 24 months. And, to hire 2 clerical staff, could cost, as we know, probably 150,000, potentially upwards, to look after that, which again, if you're only raising $10 million, but it's, it's a good portion of your performance there. So, and utilizing a prime broker or to their full extent, and that's using them as basically as an extension of your business, to get the synergies with sort of back office and corporate actions and what have you is key, and we see a lot of that, and we'll get a lot more questions coming in from the manager, and we'll essentially be their back office and speak with the administration. Speak with fund accounting and resolve all those queries, trade breaks, and that's quite intensive. It's quite an intensive role, and getting being quick on those queries means that you don't need the same amount of operational staff to do that, and so people don't really give a lot of appreciation for the cost of operations are. And the other thing I was going to say, with regard to what makes a success, you're right. I've seen fund managers come and go, and there's one that particularly comes into mind, and I think it really comes down to what you define as success. Is it exponential growth of your assets under management? You're looking to just become a profitable fund manager, or are you looking just to do performance, and understanding where you're going, and making sure that your business plan lines up with that adequately is key. Because I've seen guys start off with 50 million, and before you know it, be managing quite literally upwards of $1 billion. And what's happened is they were focused completely on growing their assets under management, because they just look at it as a simple margin of assets under management equals revenue, etc. But what they didn't properly understand was what entails that. You've got a very when you go from 50 to $1 billion, you've got many different investors in there with all competing interests that you have to keep happy. You've got more compliance issues. You've got more staffing issues, and that growth up there is all great, and it's a whole bunch of high fives. But I can tell you the way back down from $1 billion to ultimate failure was very sad to watch. So and could have been avoided, in my opinion, with perhaps not the sole focus on growing funds and having more appreciation just for the business itself.
Yep. No, totally agree. I think our fund managers need to also scale adequately, right? And also keep in mind, I mean, if things don't work out, how do they manage that sort of risk? And I guess, Willie, from your standpoint, I mean, what sort of success stories have you seen in the Australian fund management landscape? And is there a trend that you are seeing as well?
Yeah, there's a lot of definitely emerging fund managers out there that are targeting more of a Gen Y investment awareness shifting in the past year that we are seeing right now. So engagement with this sort of Gen Y investors is very important, very key. Your social media presence, as an example, investor engagement, being able to communicate to all these investors through your written publications, or even sort of phone calls kind of thing. That goes to show the care factor. But back to the point, that you raised initially, it all comes down to return. Definitely, if you got the top-notch return, there's no worry there. But if you're coming in in the middle of the pack, then you're gonna have to start thinking how to sell yourself. Like, what is the story that you're trying to sell to the investors? How does it all come together? Whether it's more technology driven or a team driven sort of storyline, that's something that you need to think about.
And I guess from Gilbert and Tobin's standpoint, I mean, you guys obviously set up a lot of fund managers here in Australia. I mean, can you give us an example of a success story, or I guess a trend that you're seeing in successful fund managers? What do they consider?
Yeah, sure, Emma. So we've set up obviously a lot of different fund managers, not just funds. And I think the one common denominator to success is a really strong leader. So if I think about all of the ones that have failed over the years, or tickled along at 20, 50 million compared to the real success stories, every single one of them has had a really strong leader. So Magellan, for example, Hamish. We look at Quadrant Private Equity, the 10th most consistent high-performing fund in the world, Chris Hadley. If you look at Regal, you've got Phil King. Metrics Credit Partners, you've got Andrew Lockhart. Every single of these success stories has a leader that is incredibly focused, works incredibly hard, can build a really good team around them. And I think most importantly, they can generate the trust, because at the end of the day, I think this is all a relationship business. And if you have someone who can build those relationships and cement them, it can only take one or two super fun relationships in Australia to really make a business. It can be 200 million from each of them to turns to 500 million. I mean, that can make a success story just in those relationships. So that'd be sort of my take. I don't know, Ty, if you've got anything else you want to add?
Yeah, and I think the other point I've seen in a few fund managers as well is really taking on a strategic partner when you're first setting up your funds management business. I think we've been involved in setting up a lot of businesses where they've actually taken on board a cornerstone strategic investor into the funds management arm of the business, not necessarily the fund, to help drive their commercial direction. And that's specifically someone who's got experience in the fund management space and can either provide distribution type services or just give some commercial advice to the manager in structuring their business and running their business at the early startup stage. So that's something we've seen in a lot of examples in the past.
Yeah, but if I can add, I mean, some of the most successful managers that I've seen grow from 5 million to 1 billion, I mean, the one trend I've seen is they're very transparent. I mean, they're happy to share what they're doing. They've got proper risk management procedures in place. They do consider, items like standard deviation. A lot of non-institutional managers, they don't care about that. But, an institutional guy who knows he's building a institutional business, he's thinking about volatility, he's thinking about risk management. So I would say transparency is something that I've seen the successful guys manage really well. And I guess, guys, let's go to the audience. I guess we've got a few questions that we've got through. So one is coming from one of our international clients, from Anil. He's asking, how's Australia as a location when compared to Singapore and Hong Kong, as for setting up a fund management company? Not the fund entity itself, but the fund management company. So maybe this is one for you guys, Nathan.
Yeah, so I think, my strong view is that Australia is probably the cheapest and easiest to set up a manager. Singapore, Hong Kong, a lot of those jurisdictions, there are tax issues with repatriating income and how those work tax-wise. And also the regulatory regime over there can be quite fluid and quite difficult compared to Australia. So, my preference is always to sort of build from here and use that as a springboard to other jurisdictions if need be. And the other point I'd make also is, 60% of capital raised in most of the funds we do these days across a lot of asset classes is from overseas. So overseas investors are very familiar with our regulatory regime. They like it. They think it's transparent and helpful. And they're very used to our fund structures as well. So, so I sort of think it's, although we do set those funds and fund manager entities up for clients, it's a lot of extra expense and hassle.
Next question is from Louise. She's asking, how do you find arranging an account with banking institutions? pain point timeframes in relation to ID and its compatibility with the reconciliation. Yes, I work at a bank. So maybe Erica, this is one you can address.
I think I know the gentleman asking this question. Well, yes, we support fund managers opening a bank account for the fund, and there are two different angles we need to look at. Often we get the question, okay, where's the money coming from? Of course, you don't know when you open a bank account because it's an investment unit trust and you're raising capital in the market. So as a fund administrator, what we do and explain to banks is, okay, as we open the account right now, we still don't know where the money is coming from. But one of our responsibilities as administrator is to make sure that we do a proper AML, KYC, CTF on the investor. So we know who's the investor, we know where's the money coming from. And we provide them often a copy of our AML program, which could either be our program or the AML program from the trustee. As we know, the trustee should have their own AML program as well. And that adds a level of comfort to the banks. Opening the bank account itself, yes, well, you will need to provide the proper documents, and we don't see this as a big issue. I mean, we explain to the client, if you would like to open the bank account, we need to have all the details of the trustee or the RE. We need to have all the details of the underlying fund. It should be certified or notarized, depending where you get the information from. We collect the information and send it over to the bank. That itself is a very seamless process. It's more the main question, where will you raise the capital? Who is adding money into the fund? But that's a bit of the chicken and the egg story. You don't know on day one. And therefore, it's important that fund administrators explain to banks and also to brokers, okay, we do have those procedures in place. We make sure we check and verify where the money is coming from before we accept the investor, before we release the money basically to the fund for trading purposes.
Yep. And I guess, guys, since we're running out of time, I guess this is a time for a shameless plug from each of you. I guess from the audience, why should they approach you guys? And, you know, who should approach you guys? What sort of attendee should approach you? So maybe Warren, you can start off, and yeah, we'll just go in turns.
Yeah. Look, obviously, you know, we really focus on early stage fund managers, and you know, I think partnering with Lazarus, what we're really good at is you know, helping clients get up and running, get to that critical $50, you know, $75 million mark where you know, they can start, you know, growing out their operations more, and potentially even look at, you know, scaling up and going to a secure a tier one prime brokerage relationship with the likes of, you know, your Morgan Stanleys or your Goldman Sachs, and you know, that typically will probably, you know, kick in around, you know, with 2 or 3 years performance behind you, and, you know, and a critical amount of fun, I suppose. So, you know, when you're, you know, if you're coming to Lazarus, we're working alongside you. We view ourselves as part of your business, as an extension of your business, and we're there to help you grow. We're there to, you know, help with all the operations. We've got dealers, you know, based globally. We can do 24-hour execution. We've got DMA, full touch. You're basically, by coming to us, you're getting an institutional tier one prime brokerage package without the necessary hurdles that you need initially to get started. And yeah.
Awesome. Thanks, Warren. And Willie, a plug for Focus Fund Solutions on who should be approaching you from our audience here today.
Yeah, as I mentioned earlier, well, you know, predominantly the client base that we have right now is the fund managers, both boutique and institutional, but you know, data knows no boundary. We work with admins, trustees from the compliance end, definitely, and also financial advisors. So we normally approach it with a free assessment to the potential clients and take it from there with the list of bespoke solutions.
Awesome, awesome. Nathan, Tom, you guys want to you know, mention who should be reaching out to you guys from our audience?
Yeah, look, anyone who wants a bit of a steer, you know, in terms of structuring things, raising money, trying to solve problems. I mean, we kind of cover pretty much the the spectrum, even setting managers up and how do you set up your incentive arrangements and structure your shareholdings. I mean, we deal with a lot of that stuff, negotiating with investors. We negotiate with a lot of the leading investors around the world. So so we cover a big group, and G&T's got the leading investment law team in Australia now. It's the largest. It's the we've got more leading practices in this area than any other firms. So I think I think you'll be looked after well.
Awesome. And Eric, last but not least, why should our audience approach Ascent, the leading fund administrator in Australia?
Well, we focus very much on what we call the startups and the mid-sized fund managers. And mid-sized fund managers for us means between 300, 400, 500 mil. I think it's important to understand that we try to customize the service to what a client really need to receive. So it's not just an off-the-shelf product. No, we listen to the problem. We build a product that fits the client, and that's typically the boutique approach. And that goes back to, if you talk about startup fund managers, fee structures. And we're building a long-term relationship. We don't want to kill a startup fund in year one with all the fees. No, it's a long-term relationship, so we're quite flexible in our fee offering to support the manager to build a track record. Another way of boutique service is the reporting to investors, as we discussed before. You stand out from your competitors basically if you customize reporting to your investors, and we're able to do this. We're able to build this for the fund managers. So yes, if you really want to customize your product, if you really need attention, then you should definitely speak to the team of Ascent in Australia, because we're here to support the managers and to help them grow the business.
Awesome. No, appreciate it. And thanks for all the attendees for joining in today. If anyone has any questions, feel free to reach out to me, and I can make sure that you're connected with the panelists. If you have any specific questions, on the legal side, PB, on the technology side, feel free to drop me a note. Thank you again, panelists. Great session. Really appreciate you guys sharing your knowledge on the fund startup realm. And that is all for today. And I hope we see everyone for the next webinar. Thanks all.
Thanks all.
Thanks, Emma.